Good day to all. This is our second part for our discussions involving property, plant, and equipment part 2. This is part 2B that discusses the continuation about subsequent measurement, depreciation, and revaluation. Please take note that we are done with our subsequent measurement. We introduced our depreciation methods, and now this is the continuation. Leasehold improvements are basically the additional items or additional PPE items that are made out of leasing or renting a certain property or premises. So example, let's say you're renting a building and we expanded that or we made a certain expansion out of that. Or let's say we rented a land and we constructed a certain building for that. So basically that's going to be a leasehold improvement. So in this case, a leasehold improvement is to be depreciated over the useful life of the improvements or the remaining lease term, whichever is shorter. Since normally for our lease contract or rent contract, we have to take note that we are limited by our lease term or the lease period. Say, for example, it's just good for 20 years, but our building is good for 30 years. When we depreciate our building, then we are going to make use of the shorter. Another emphasis is on the word remaining, since it's possible that we or when we rented out that particular property, plant, and equipment, basically there's already a portion that has expired of the lease term. Let's say it's good for 20 years or let's say 30 years, but 5 years has expired already. Therefore, we're just going to utilize the remaining number of years. So in that case, take note whichever is shorter. Second point is an option to renew the lease is considered when determining the shorter between the useful life and the remaining lease term. If it is probable that the renewal option will be exercised, that's true. Let's say our original contract is good again for example 20 years, but we are given the option to renew for let's say 10 years, and then it is probable, meaning to say the chance that we will renew is greater that it will not. So that's what we are going to do by then. Then the next part will be, what if there are changes in depreciation method, useful life, and residual value? Since depreciation method is treated as a change in estimate, meaning to say that because of certain components of computing depreciation like the useful life, which is the next item, and the residual value, then whatever is the resulting figure, which is the depreciation expense, as well as the accumulated depreciation for the sum of depreciation expenses later on, are based on estimate. Therefore, any change of any of the three doesn't necessarily mean that all of them will be treated as a change in accounting estimate under PAS 8 or IAS 8, which is accounting policies, changes in accounting estimates, and errors. So that's our complete title. And the change is accounted for prospectively or proactively, meaning it will benefit current and future accounting periods. As explained in the next point, that prospective accounting means the change affects only the current period and our future periods. The change does not affect the past. Otherwise, we call that retroactive application or retrospective application. Again, we'll account the three prospectively. So whatever is the remaining balance of the property, plant, and equipment, that is what we are going to use to account for the changes. And normally we use the remaining useful life or the revised remaining useful life. Let's say, for example, our previous estimate is 20 years and 5 years has passed, so that's now 15. And then we're going to make use of the 15 years. But let's say instead of 20 years, it's really 25 years. So minus the 5 years that elapsed, mean to say we are going to use 25 minus 5, 20 years for our useful life. So revised to remaining useful life. Okay, we do not change the past, but we just have to carry over or forward in the current and future times. Next, for major parts which are actually replaced. So what we do with such, if we can recall a while ago, so what we're going to do for such, I've mentioned, if you can recall in the 2A portion of PPE part 2, that we have, let's say, airplanes, wherein there are certain major parts like the wings, the body or shaft of the airplane, then the engines, the gears, the wheels, for example. If ever the major parts, which are actually to be depreciated separately, have been replaced because they are damaged or destroyed. So in that case, of course, the replacement part has to be recognized, while the carrying amount of the part that is replaced is the recognized or removed from our accounting books. So meaning minus the part that is replaced with its carrying amount or book value, and then the replacement part, or the part that is used for the replacement, is to be added to the book value or carrying amount of the asset as a whole. Then if the carrying amount of the replaced part is indeterminable, so in this case, the entity may use the cost of the replacement as an indication of what the cost of the replaced part was at the time it was acquired or constructed. So in other words, we are going to use discounting, or we will compute the present value of the cost of the replacement today, and then we are going to use a certain discount rate applicable certain years ago to estimate the cost of the replaced part, or the amount of the replaced part, again years ago. And that will be used as the way of computing the carrying amount. And then whatever is the carrying amount, again, based on the estimate, will be deducted or to be removed from the value of our major parts. Next would be revaluation model. So this is one of the two models, as what we've said in 2A, that there are two models, the cost model and the revaluation model. The cost model is simply straightforward. Whatever is the cost, we deduct our accumulated depreciation and accumulated impairment losses, in which again, the last part, impairment, will be discussed in other series or in other accounting standards in intermediate accounting. And then we also have to take note that in computing our carrying amount, it's cost minus the accumulated depreciation and accumulated impairment losses. However, for the purposes of computing the depreciable amount, which is to be used for our depreciation, it is cost minus the residual value. But we do not deduct the residual value to get the carrying amount. Hopefully that is clear. For evaluation model, it's the same. When we say of the carrying amount or the book value or carrying value or net book value, we are going to use the same formula. So whatever is the cost less any accumulated depreciation and accumulated impairment losses. However, they are based now on the revalued amount. So we are going to estimate how much is the value of the PPE really at the current times, and thereby getting, for example, our depreciated replacement cost, or even its fair value, but the fair value is really the value now at the current time. So we have to gross up, or we have to work back with the value of the replacement cost as well as the accumulated depreciation. Then formula for revaluation surplus is actually fair value less carrying amount. The revaluation surplus is when we are going to compare how much is the value of the PPE under the current times, that's the fair value. And this is the amount in which two willing and knowledgeable parties are going to enter into a contract with such amount or value. The less carrying amount, which is again the difference between our cost and less our accumulated depreciation and impairment losses. So whatever is the result, then we are going to get the revaluation surplus. Now, this is in accordance to PFRS or IFRS 13 fair value measurements, that as a rule, generally speaking, meaning it is with exception though, that we can really determine the fair value using an appropriate valuation technique. But the fair value is to be estimated by experts, not us. In the accounting field and business field, we know how to journalize transactions, we know how to compute depreciation, but in terms of how much really is its fair value at the current times, even with the basic ones, residual value and the useful life, you are not experts of that. So we hire specialists for this. For the formulas after the revaluation surplus, which is very important, and that's gross of tax, by the way, these are also other formulas. To get the total economic life, or TEL, that's effective life plus the remaining economic life. Then percentage of depreciation is the effective life, meaning effective life is the current life divided by the total economic life. And then depreciation is percentage of depreciation, which is the second one, and multiplied by the replacement cost. And the fair value is replacement cost minus the depreciation. So these are our formulas that we have to know involving our revaluation. So we will be discussing them in details, hopefully with certain sample problems. For now, it will be just the theories. Then there are two methods of recording or recognizing or incorporating our revaluation. So it's either we do the proportional method or we do the elimination method. Either of the two would be fine. It's just that proportional method has been used by a lot of people and experts and learners and practitioners, and even me. I also make use of proportional method because it's just enjoyable to make use of the tables. The gross carrying amount is adjusted proportionately to the change in the carrying amount. So example, if we have noticed that the accumulated depreciation for a 10-year useful life, 3 years has expired. So that's 3 over 10, that's 30%, assuming that the cost is 100%, meaning to say the carrying amount is at 70%. 100% minus 30% respectively equals 70%. So that would be true also to our, by the way, that's going to be the resulting carrying amount. And then after that, we are going to, of course, use the same concept or formula, which is at 70% for our replacement cost. So the current value to get our fair value. And the difference between fair value again and current amount is our revaluation surplus. So that's the concept that we said a while ago. Let's go back to our formula here. So to get the fair value, that's going to be the cost. And then based though on the replacement cost, so the updated one, less the accumulated depreciation on the current one. Well, the carrying amount is the difference between the cost, which is prior to revaluation, and the accumulated depreciation prior to revaluation. And the difference of the two again will be the revaluation surplus. So surplus is excess. On the other hand, if we say elimination method, the accumulated depreciation is simply eliminated against the gross carrying amount of the asset. So in other words, we do not credit accumulated depreciation. Instead, we use whatever account title appropriate to the PPE, whether that's equipment, or that is building, or any other asset that is revalued. And under evaluation method, frequency or the time in which we are going to do this, how soon do we do this? So for items with significant and volatile changes in fair value, necessary that we do the annual evaluation. But if there are insignificant changes in FV or fair value, we might or we may do this every 3 or 5 years. This is based on PAS 16 or IAS 16 property, plant, and equipment. Then revaluation, as explained, has to be applied to all assets in a class. If an item of PP is revalued, so let's say a certain building has been revalued, meaning all buildings should be revalued as well. The items within a class of PP are revalued simultaneously. So all of them has to be revalued in the class, I mean, to avoid selective revaluation of assets. And there would be differences of the values to be presented in our financial statements and reported to the financial statements for those same classes of assets at different dates. So to avoid, for example, building 1 is a cost model, building 2 is revalued, building 3 is cost, building 4 is still cost out of the 10 buildings. So to avoid the mixture of different values. And then what about for subsequent accounting for revaluation surplus? We have to take note that this excess of revaluation, which is again the difference between our fair value less carrying amount, is a matter or an item in our OCI or other comprehensive income section. It's not part of our profit or loss. So it's part of other components of the comprehensive income. And basically, this is about management stewardship or management care of our resources of the entity. So in that case, it's OCI item, account title is revaluation surplus, unless there would be impairment loss or reversal of the impairment loss, in which, in that case, that will be recognized in profit or loss. Under IAS 36, all impairment losses shall be recognized immediately. And also the reversal in which instead of the impairment, it improved later on. So whatever has been recognized before shall be reversed, but any gain should not exceed what has been recognized before. So that will be tackled in problems. Then subsequently, the revaluation surplus is accounted for as follows. For the revalued asset, or if the revalued asset is non-depreciable like land, we do not do the piecemeal realization. What is piecemeal realization? That means that the revaluation surplus in the OCI section will have to be allocated, will have to be transferred to the retained earnings, the old term, that is retained earnings. Now it's accumulated profits and losses as the asset is being used. So let's say after revaluation, the asset can still be used for 7 years. So whatever is the revaluation surplus, we allocate that to the 7 years. That is for depreciable, number 2. It's like we started anyway with non-depreciable, but we jumped to depreciable. So same thing. Depreciable is we do the piecemeal realization, but for the non-depreciable like land, in which that is not to be depreciated, so it is but just that we do not do the piecemeal realization, in which we will transfer again revaluation surplus or RS to accumulated profits and losses or retained earnings as the asset is used throughout the year, say for example 7 years. So instead, it will be one-time transfer when the asset is derecognized or when the asset is sold or disposed of by the entity. Now, for the recognition, as explained a while ago, this is when we are going to remove or exclude the value of the PPE item on our accounting record. This can happen normally in or on disposal when we sell our PPE item, or when we evaluate the PPE, no future or further future economic benefits are expected from its use or disposal, as a review of what we've said in part 2A. All right, so thank you very much for listening to our discussions. Hopefully you got something from this. Thank you very much again, and God bless us all.